when people are saying, when's gold going to move? Uh, those people who were buying gold because it was oversold and it would come back should sell. You know, if you owned gold for trade, you got your trade. Kiss it, move on. That's not why I own gold. I own gold because I have a sense of history. I own gold because gold has done well when people are concerned about the maintenance of their purchasing power in fiat denominated instruments. And I think that fear is just getting started. I can't talk to you about Australian math, but let me give you some American math. Uh, the on balance sheet liabilities of the US government exceed 36 trillion US dollars, not Australian dollars, US dollars. But the off balance sheet liabilities are even worse. What are off balance sheet liabilities? They're old guys like me. Medicare, Medicaid, Social Security, federal government pensions, military pensions. That number, the net present value of that number, is $100 trillion. The American Internal Revenue Service estimates that the private net worth of Americans is $141 trillion, and our government owes 130 of it. This is a lousy number, Shay. I mean, this is a really lousy number. I believe that we deal with that debt rather than honestly by defaulting dishonestly. In particular, I think that we do what we did in the 1970s, which is to say that we devalue the purchasing power of the US dollar. You honor the nominal value of the obligation. You say to some old kook, Rick Rule, we promised you $4,000 a month in Social Security, and you're going to get it. But we're going to devalue the dollar so that the $4,000 buys you $1,000 worth of goods and services. In the 1970s, according to the Congressional Budget Office, the US dollar lost 75% of its purchasing power. That's how we dealt with the debt built up by the war in Vietnam, which, by the way, we lost, and the war on poverty, which, by the way, we lost. My suspicion is, over the next 10 years, the purchasing power of the US dollar declines by 75%. In the 1970s, when we devalued the US dollar by 75%, the gold price ran 30-fold. I'm not suggesting to you that gold runs 30-fold from here, but I am suggesting to you that there is a probability that gold's rise keeps pace with the decline in purchasing power of the US dollar. That's a pretty attractive proposition. People ask me, well, Rick, you know, you've been bullish on gold for at least 5 years. What would make you sell? That one's easy too. If the reason to own something goes away, the thing has to go away. So they would need to balance the US budget. They would need to have positive interest rates in the US. By positive interest rates, I mean that the interest on the US 10-year Treasury would have to be larger than the deterioration in the purchasing power of the US dollar. And they would have to have a fiscal plan in place to deal with $100 trillion in the net present value of government liabilities. I suspect 10 or 12 years from now we'll get there. But I don't suspect in 2 or 3 years that we'll get there. And I'll give you one more piece of really cool math. JPMorgan Chase suggests that the market share of precious metals and precious metals related assets relative to other asset classes in the US savings and investment market is 0.5%, which is to say, if you look at every investment and savings asset class in the United States, only 0.5% of our total portfolio is denominated in precious metals. JPMorgan Chase says that the 4-decade mean market share is 2%. If negative real interest rates and debts and deficits begin to concern people the way they concerned people in 1971, 1972, if gold was to return to mean, that would give you a 4-fold increase in demand. I can't tell you what that would do to price, but I can tell you that the number is much likely to be higher than lower. So I am and remain a gold bug. I've graded tens of thousands of portfolios in the last 25 years for free. And although I've taught a lot, I've learned a lot too. I've learned that most investors make three mistakes. They buy stuff that's hot rather than stuff that's not, which is to say they overpay. The second thing that investors do is they own too many stocks. They own way more stocks than they can possibly keep track of. But the most important single mistake that people make, the most important mistake is most investors that I know get the long-term strategy right, but their tactics are short-term. Somebody believes that gold is going to do well over 5 years, but their anticipated holding is over the next long weekend. If you don't synchronize your expectation to the time that it will take for your expectation to play out, you're going to lose. Long-term strategy with short-term tactics does not intersect. You know, the great American mutual fund group, Fidelity, with millions of investors, looked at their whole investor database and they stratified them by various factors. Zip code, net worth, race, gender, age, all this kind of stuff, to try to figure out how to market to various groups, but also to try to figure out what various groups did right and did wrong. The subgroup that they came up with that outperformed every other investment class was dead people. Estates outperformed other investors because estates didn't trade. They didn't go from hot sector to hot sector. It teaches us a lot. If dead people can outperform active money managers, it tells you a lot about the right holding period for good investments. Natural resource-based businesses are capital intensive and cyclical. And a commodity that's out of favor is out of favor because it's cheap. And the fact that it's cheap means it's going to be dear. When you and I started talking about uranium, the stuff was selling for 20 bucks a pound, and it cost 60 bucks a pound fully loaded to make it. So the industry was losing $40 a pound, and of course being dumb miners trying to make it up on volume. At $20 a pound, the industry was going to self-liquidate. The price had to go up or the lights were going to go out. In sane jurisdictions, either the price was going to go up or the lights were going to go out. Nobody wanted to own a commodity that had to go up in price. 4 years later, the price had gone from 20 bucks a pound to 100. It didn't have to go up anymore. And all the people that didn't want it when it had to go up wanted it desperately when it already went up. In other words, the price action had to justify the narrative. But by the time the price action had justified the narrative, there was no value left in the sector. I have a phrase which I use to teach this. It says, in natural resource investing, you are either a contrarian or you're going to be a victim. The widespread hate in the uranium sector right now attracts me. It tells me I'm in the right place. I don't have much competition. So that's attractive to me. But there are other commodities that aren't attracting any attention at all. And I probably like them better. So on a global basis, we're selling platinum for less than the fully loaded cost to produce it. In addition, there are outstanding political risks. The big producer is South Africa. It only aspires to be a basket case. The second biggest producer is Russia, an active basket case, but in a war. The third biggest producer is Zimbabwe, which probably will never be a basket case. In one of those three countries, the supply of platinum goes away, but the demand, its use in internal combustion engines to reduce smog, never goes away. So if you can buy platinum deposits that aren't in production currently, that are world scale, that would be in the lowest cost quartile in the world were they in production, and the highest quartile in terms of return on capital employed, this is really what I've done for a living ever since I've been cognizant. And there are a couple of those out there. I'm really attracted to rare earths because people don't understand them, and they were a fad. So like uranium, people hate them. A whole bunch of people crowded into rare earths without understanding that they weren't rare. And when all these people crowded into the rare earth space and it looked like the prices were going to go up, the Chinese increased production and blew everybody else out. Now we have geopolitical tensions, and the Chinese are less likely to sell the rare earths. At the same time, the Chinese production costs are increasing very rapidly because, like with lateritic nickel, the environmental destruction that accompanies the traditional Chinese production technologies are not any longer tolerated by the Chinese people or the Chinese government. So very high quality rare earth deposits with at least $20 billion in situ recoverable reserves and resources that would be theoretically in the best quartile by way of cost curve and the best quartile with regards to returns on capital employed attract me. One such in Australia is Meteoric. You need to understand that Meteoric needs to do a financing. And so I would suggest to Australian punters that you get that out of the way. You let them resolve their balance sheet issue. It's in a country that folks hate, Brazil. It's in a category, rare earths, that most folks have lost money on. Those who haven't didn't know it existed. So it really comes into my sort of unloved camp. Ironically, the only thing that I see that really interrupts my thesis is it might get taken over by Rio. If that happens, I don't get the full realization of value, but I get paid a premium. When we talk about these stocks, Shay, they're very small. They're very thin. I would ask your readers to use good till cancel limit orders. Don't fall over each other buying these things. An audience as broad as yours, if they all compete with each other to buy the stock, there's a 6-week frenzy, pardon me. People paid too much. They bailed out existing shareholders. That's really stupid. The thesis that I have put in place will be as valuable 9 weeks from now as it is now. So use good till cancel limit orders. Be patient, get filled. You're going to own this thing for 5 years. If you don't get to own it for 9 weeks, that's okay.